Good day, Toby Love from the Accounting Club, where we enable you and your business to succeed. And thanks for watching our channel. This is our YouTube channel, and please subscribe to our channel if you can. We'd like you to subscribe to our channel. Today is the 24th of June, 2025, the last week of the month, and we have just about 4 working days left to the end of this month. So this month we have been busy with I said this month, today or this week we have been busy with payroll. So this week there's going to be a lot of money flow in out of businesses into individuals' bank accounts. Okay, so money flow in terms of payrolls, employees getting paid, employers paying money out to employees and HMRC for their taxes. So a lot of money flows, and you work, wait to the end of the month for you to get a big lump sum of money, and then you wake up by morning the next day, and 80% of that lump sum you received is gone by way of direct debit, standing order, bills you need to pay. It is interesting, which is why it is important to have try and have multiple streams of income if you can. So we're busy with payroll, and then what we do with payroll, it involves us obtaining payroll information from employers, putting that through our payroll software, calculating pay and ensuring it is correct, sending it to the employers for review, and then actually processing them, submitting them to HMRC, sending out pay slips, payroll reports. There's pension as well, where employers have to have pension schemes where employees are automatically enrolled. We do assessments on that and do some filings on that as well. So if you're not in a pension scheme, speak to your employer, or you can set up a private pension scheme for yourself. So and this is the same thing that we do even if you are a director of your own limited company. It is what we do, where we run payroll for you and send you the pay slips, and then you make the payment. So busy week with payroll, as well as the regular statutory deadlines for filing accounts, VAT returns, which are due on the 7th of July. We have most of them prepared there for accounts. We have most of them. We filed most of them. Just going to check that there is none, because there's usually that one that you might miss. So I just do a check to make sure everything is submitted, so avoid late filing penalties. VAT returns are also getting in. We have a few late ones, but we have enough time to get them in. So today I just want to go over a couple of things in this video very quickly. I'll provide some market, tax, and business updates. And I'm going to share my screen now. So in terms of Market Watch, share screen. All right, so I'm going to share my screen now. Yeah, that one. All right, so I'll quickly go over Market Watch. Something I found out about UK property, some employer news, 1 or 2 tax traps, and then webinars that we have. All right, so in terms of Market Watch, referring more or less to investments here, and knowing what is going on in the market. Okay, so you have to be informed. You have to invest in getting information, invest in financial literacy. You don't have to do anything with it right now, but having some financial literacy is good, and just reading up information is good. So I use this website, investing.com, just to get an overview of market trends, what's going on in the market. So You can look at indices, stocks, there, commodities, cryptocurrency, currencies. So you can use that to have a quick look at what's going on overall, picture of what's going on in the market. But then you can have a more detailed, in-depth look at it. So today I'm going to have a look at, I also use this website, TradingView, and then it gives me, with TradingView and some other, what do you call it now, indicators. It helps with showing, this is the way I understand it, okay? It helps with showing the emotions in the market. So this is the NASDAQ, and I have interest in Amazon shares. I hold some Amazon shares, and I am interested in buying some Alphabet shares. So I just use this to check on where we are in the market. We know over the weekend, with the bombing of Iran and Trump declaring ceasefire yesterday or today, that's caused a bit of volatility in the market, and we saw that volatility, I think, a lot more in cryptocurrency, in crypto assets. So I use this to check where we are. So Amazon is currently at 213. I bought Amazon a couple of years ago, and I'm still holding. I'm not selling them. So I'm trying to look for an entry point, and what this chart is telling me is here you have the stochastic RSI, and this is on the daily chart, and below you have the RSI, okay, and the stochastic RSI is below 20, and you can see when it's above 80 into 100, that's when we kind of have a peak, and then when it's below 20, that's kind of when we have a bottom. So it does look like I'm not going to say we are at the bottom or at the top. What I can see here is the prices has come down and is likely to go up, but I don't have a clear clue as to whether it's going to go up or down. On the weekly chart, it's just below, coming below 100, and it looks like it's going to trend downwards. So I'm just going to keep a watch on it. I'm trying to find, with things like shares and stocks, I just buy incrementally, okay, not all in one go, to kind of average out my price and wait for it to go up. But always look for an opportunity when there's a price crash. In terms of Bitcoin, cryptocurrency, this is let's go on the daily chart. On the daily chart, you can see we have this downtrend for that, which was, so this downtrend, I believe, was compounded by the bombing of Iran, and then with the announcement of a ceasefire, it looks like we're having some form of recovery, upward trend. And if I'm looking at what I'm saying here is not financial advice. Okay, this is just what I'm seeing on the chart. All right, so, and on the chart, the stochastic RSI was down here, and then we had we had downward continuation, mainly because of the war, the bombing of Iran, you see. But then we are trending upwards on the daily chart. But on the weekly chart, we have a bit of a downward trend, and then the weekly chart is saying to me that it is likely that we see lower prices. There is no guarantee that that's what's going to happen, but that's what the chart is showing, that might see lower prices on the weekly chart. On the monthly chart, it looks like we're going to be trending up on the stochastic RSI. So you can see that the chart actually appears to be all over the place, and it's not giving a clear indication of what direction this might go. Solana, I just look at Solana, same thing. Daily chart looks like we are having a upward trend on the daily chart. I mean, you can see this green candle from yesterday and today. It's struggling to continue with the upward momentum. So I think that we will bounce in this region. I mean, the stochastic RSI is crossing up, and I mean, historically, you can see it usually needs to go and at least get to maybe 100 before coming back down. So I think that we're going to dance up and down, up and down, up, down, which is the situation with cryptocurrency. Up, down, up, down, up and down. Okay. So that's quick overview of the market. What am I doing? I'm watching the market and trying to wait for an opportunity. I mean, you're not going to get the top price when you want to pull out. You're not going to get the lowest price when you want to go in. What you want to do, or what I do, I try as much as possible to minimize my risk on here. So when there is momentum, it's not usually a good time to buy because it will come down, as we can see. I mean, historically, it's gone up, it's come down. So it might just take a while for it to once what I know from this chart is there has been an uptrend, and it's going to struggle to decide, okay, is it going to go up or down? And then at some point it will come down, it will go up. And you can take advantage of that if you know what you're doing. All right, so that's just a quick overview on Market Watch and what I think. It is not financial advice. That's just what I think based on the chart. So moving on to UK property, something I found which caught my interest. I'll share that. All right, so I mean, one of the things you could invest in the UK is property, and it's on not on this one, and property, you can see it is physical, less risk. Of course, there are some risks. You have huge capital investment, it is capital intensive. Okay, you need huge capital to start, depending on what strategy you're using. I know there are some strategies out there that you don't need to have capital or even have as much capital. But as an investment vehicle, it is physical. The risks are low. If you're worried about your investment, then you sell the investment, you get your cash back into your bank, and you have a good night's sleep compared to the stock market or cryptocurrency. All right, so here's what I found, which is a bit interesting. So we have this document is the residential property transactions in the UK. So residential property transactions completed in the UK. So this is the statistics of property transactions. So when you sell a property, when you buy a property, HMRC is aware. Okay. All right. So, and this is based on a tax year being April to March every year. So if we look at 2024 to 2025, right? This is saying that in the UK, across England, Scotland, Wales, and Northern Ireland, there was 1.2 million transactions relating to property. Now, I haven't looked into this in detail to know if these are disposals or acquisitions or a mix of both, but I think it will be a mix of both. So I will need to talk a bit more on this at some point when I delve into this data to fully understand. But I mean, property transactions, 1.2 million. Are you part of the 1.2 million here? I guess that's what I'm going to. You should consider and think of being included in this, your property being included in this statistics as a long-term investment strategy. Right, this information is publicly available on HMRC website. Okay, so I just find it interesting to see the volume of transactions that that happens, and on a monthly basis. All right, so April 107, May 109, June 124. So it looks to, so we're having at least over 100K transactions, property transactions monthly. That's very interesting. And I mean, it is my goal to increase whatever it is I am doing in relation to property. And now moving on to some employer news. Now, this may not be applicable to everyone, but it is still relevant. So if you are an employer, that means you have an employee. And employers include limited company directors who run payroll and draw a salary. You are an employer if you run payroll, even for yourself as a single director. You are classed as an employer. And as such, you have some filing deadlines that are coming up on or before the 6th of July 2025. So if you have if you have benefits that is not to salary or dividends, then you have to report that on what we call a P11d. So these benefits can include private things like private medical insurance, living accommodation, employer provided accommodation, company car. I mean, any cycling, any additional benefits provided to you as an employee over and above your salary and dividends that you take. Okay, so you have to report that on a P11d on or before the 6th of July 2025, and then payment made before the 19th of July 2025. So this is something that you usually report using your payroll software. So as an example, if you have a company car, right, that you use, the car would have what we'll call a cash equivalent. So let's say a BMW worth £35,000. This is just guess, not exact numbers. When you put it on the P11D, it may come out with a cash equivalent value of £6,000. So let's say you have earned a salary of £24,000, right? With your car benefit, given a cash equivalent value of £6,000, that means your gross earnings will be £30,000 for the year. Okay, so £24,000 would have been taxed through your payroll, but then the £6,000 you need to tax on your self-assessment tax return, which is the reason for having a P11D. The employer will pay national insurance on that, whilst the employee will pay additional income tax. Now, And the change coming into play in 2027, this was meant to be in 2026, is the P11D is being abolished. So that would, because I mean, a couple of employers have forgotten to file P11Ds, then they've got penalties. I think this is a good development where the P11D has been abolished and HMRC is mandating that payroll benefits are reported to the payroll. So all benefits would be reported on the payroll from April 27. So I think it's good. I think it's a good development going forward. I mean, but they've pushed it forward to April 2027. Yeah, that's what I wanted to share briefly on employer news. Now let's talk about tax traps. I came across this Spotlight 68 using prepaid debit cards for profit extraction to reduce profits and disguise income. You know, as an accountant and then tax advisor, one of the challenges that I have, or one of the interesting things that I've come across, is that we want to help clients reduce their tax as much as possible. But if you're running a business generating income, you would also have to pay some tax. And there's usually this one scheme or that scheme that seeks to promote reduction in tax company tax liability. So this scheme, as I already is a scheme where a director or associated person would spend money on advertising or some other form of expenditure. Okay. Then from the vendor, they get like 80%. So you spend like maybe, let's say you spend like 10K on the company, maybe you spend like 10K on company advertising, okay, from ABC with ABC Limited. ABC Limited will now give you £8,000 in the form of loyalty points into a prepaid debit card. So what HMRC is saying here is that is tax avoidance. And this is what the Spotlight 68 is all about. So they're saying the 10K spent on advertising is not legitimate because you get 80% back in the form of loyalty into a prepaid debit card as a director or associate of the company. And I can see their point. So if you have come across this and you know someone that is using it, please beware because you may end up having to pay more tax than you think you want to save. So just watch out for these schemes and make sure that you are not exposing yourself unnecessarily to more tax than you want to. The other bit of tax trap I would like to talk about is what we call payment in account. Right, so if you are a director earning income through dividends or where you have earnings where you have to do a self-assessment tax return, you would have a tax liability, okay? Where your tax liability is greater than £1,000, HMRC requires that you pay your tax liability in advance, okay? So this means you make 2 lots of payment. So you have the tax year, the tax liability for the current year, and then you have the tax liability for the next year. So in the current year, let's say your liability is £5,000, the current year being 2024-25, your tax liability is £5,000. HMRC requires you to make that same amount towards your 2025-26 liability in advance, which is why it is called payment on account. So rather than making a payment of £5,000, you will be making a payment of £10,000, right? So your £5,000 for your tax liability, the date on there have not been updated. Apologies for that, but I mean, you get what we're trying to say here. £5,000 being the liability for the current tax year due by the 31st of January. Then 50% due by the 31st of January, 50% additional. I'll show that on the spreadsheet so it makes more sense. And then 50% due 31st of July. So I'll show that on a spreadsheet to try and make it have more sense. All right, so we have two tax years here. One ending in 5th of April 2025, which is the 2024-25 tax year. The other one's 5th of April 2026, which is the 2025-26 tax year. All right, so your tax liability for the 24-25 tax year is £5,000. This is due on the 31st on or before the 1st of January 2026. Then you have the 2025-26 tax year, which HMRC estimates that you will have the same level of income, so you will have the same tax liability. Therefore, the liability for this is £5,000. This is due for payment on or before 31st July 2026 and 31st July 31st Jan 2026 and 31st July 2026. So what happens is you have the tax liability for the 2024-25 tax year there. Then you have the liability for the 2025-26 there, which is your payment in advance, your payment in account. Now this payment is broken down into two lots. Okay, so the first one is due on or before 31st Jan 2026, and the other one due on or before 31 July 2026. Okay, so come 31st Jan 2026, you have to make a payment of 7,500, which is that 5,000 there plus that 2,005. And then come to the 1st of July 2026, you make a further payment of 2,005. When you add the two together, that comes to 10,000. When you add these two together, that comes to 10,000. All right. So your tax liability is £5,000, but you pay £10,000. Okay. So that is what payment on account means. So when you see your tax return and you see, oh, my tax liability is 1,000, but I'm being told to pay £2,000. That is the reason why. Now you don't have to pay, you don't have to do this, you don't have to pay that, okay? And or you can pay only your tax liability, yeah? But if you do that, when you come to do your tax return for this tax year, that payment that you didn't make will be deemed as late, and HMRC will apply late payment interest and possibly late payment penalties. Okay, so if you're struggling with cash flow, you may avoid paying your payment on account, and you have some interest. Or if you're struggling with cash flow, you could have your tax return prepared before July each year, okay, so that the payment, you can understand your payment, and if your tax liability is reduced, then you won't have to make a payment on account. So if you choose not to make that payment, you will be liable to interest and possibly late payment penalties. If you do make the payment and your tax liability is, so let's say you made the payment on account and your tax liability came to £1,000 for this year, that means you would most likely have money coming back to you from HMRC with interest. Okay, so they pay you for holding your money. So you're not really losing money where you make your payment on account. It is a dent. It will be a dent in your cash flow for sure, for certain. But you're not losing that money. If your tax liability is not up to that, you will get a refund. Right. So those are the two things I want to share on tax traps to avoid or to consider, or things to consider. And then finally, on this video, we have a webinar coming up on the 30th of June, where you so if you go on Eventbrite, you could do a search for this topic, the tax savvy business owner. And here we'll talk about what you can do, what you can consider to structure your business in a way that you reduce your tax liabilities. Tax planning is an active endeavor. Okay, many times I've done accounts and then the owner tells me, oh, I need to pay less tax. But you've traded. If you want to pay less tax, you need to plan ahead, not when you've actually traded and um, received all the money into your bank accounts, made all the profit. You need to know what your tax strategy. You need to have a tax strategy before you start making profit, before you start that business. And every 12 months at the beginning of your financial year or trading year, you should always review your tax strategy to stay on top and to reduce your tax liability. So if you are available to join, you come to Eventbrite and then sign up. Yes, this is paid and it's not refundable. If you It's at 6 p.m. to 7:30 p.m. So join us if you can. Register to join, and look to provide you with more information at this webinar. So that's it for now. I hope you found this useful. Like and subscribe to our channel, and until next time, to be loved from the Accounting Club, will enable you and your business to succeed.